What is a financial product? A financial product is a contract between two agents stipulating movements of cash now and in the future. Here is a representation of what's exchanged today between agent A and agent B. A contract is received, and actually there may or may not be movements of cash today. That's what I just said. Actually, there may be no movements of cash today, but there must be movements in the future. And the future movements depend on various conditions that are stated in the contract. Therefore, time plays again a fundamental role. The simplest such contract, of course, is the plain vanilla bond. For instance, what's called a 1-year 3% bond. Here is the way we represent it from A's viewpoint. Today, A pays out, for instance, 1,000 euros to B, and in 1 year, B will pay to A, therefore A will receive 1,030 euros. There can be many more types of financial products. We shall see in this lesson that insurance policies are a financial product. Something called futures are financial products. Options are financial products. And there exist also more complex products called structured products. Modern money itself derives from simple financial products. Modern money is made of receipts for deposits of real money in a bank. It has a status called legal tender that I'll explain in a minute, and it bears no interest. Actually, that's one of the aspects of modern money. Banknotes that we have in our pocket are also receipts given by a bank that has been selected and has become the central bank to a state in exchange for a loan. And of course, all this is a bit intricate, so let's clarify that. At the time of this operation, here's what takes place. The state gives a promise, that is a loan, to a central bank, and receipts are given by the central bank to the state, and these are banknotes. The balance sheet of the central bank after the operation looks like this, if it's the first operation of the central bank. On the asset side, we have debt from the state. That is, the state owes some value, money if you like, to the state, but this is the creation of money. And on the liability side, there is recorded in the books of the central bank the receipts given to the state for this asset of the bank. And these receipts are banknotes now in the state treasury. And the state pays with that civil servants and various other things. And eventually, all these banknotes ooze somehow into the society, into the population. Money will be explained in the third course of our trilogy. This trilogy is made of our course in accounting, http://lapasserelle.com/accounting. We are now in the course in finance, same address with /finance, and I will also prepare a course with the same address /money. So let's continue with the notion of value, tangible value, and promises of various sorts. Here is an example of tangible value, value that can be consumed, a sack of rice. I could also have represented a tool, a hammer or a violin, but it would be slightly different already. We don't eat a hammer, whereas we eat rice. By some sort of convention, since at least Neolithic times, which represent a turning point in humankind, gold is considered as incorporating its own value. Here is a representation of some gold. Think, for instance, that when President Ben Ali fled from Tunisia recently in 2011, he took with him 1.5 tons of gold. And now let's turn to promises of future value. Here's one of them. It's a $100 US Treasury bond. It's not a banknote. It looks like a banknote, but instead of being a greenback, as we say, it's orange. Here is a very well-known type of promise. It's a promise with a legal standard status in various regions of the world. What does this mean? It means that if I owe you $100 in this region and I give you this, you cannot refuse it. It has a legal tender status. Here's yet another type of receipt. That's a receipt given to someone in 1915, acknowledging the deposit of some gold in the Banque de France then during World War I. And we will understand later on how come such pieces of paper that I've been showing enable a community, a society if you prefer, to function. It's somehow strange. Finance, being about promises, requires powers able to enforce these promises. That is why modern finance and modern money developed in parallel with the emergence of powerful monarchies in Europe, what's called absolute monarchies, when they reached their climax in the 17th century. But they developed between the year 1000 and the year 1700. That is after the end or the beginning of the end of feudality itself having replaced, it's a long story, the fall of the western part of the Roman Empire. And then after the climax of absolute monarchies in Europe appeared various republican systems, but they kept or maintained the centralized powers that the monarchies that they replaced had. Nowadays, present-day nation-states are slowly losing power. That is due, we are in 2011 now, that is due to the new communication systems, that is in short, internet, but more specifically the possibility to send emails and now tweets and things like that, that enable people in a society to communicate very easily, and it can be controlled by the states with more difficulty than in the previous decades. For instance, the ex-Ottoman Empire post-colonial states, Tunisia, Algeria, Egypt, and perhaps now a few more, are undergoing revolutions, and this is due in particular to that. And also the third factor is that international firms now, some of them are capable of maintaining systems of signs, that is money, better, more efficiently than states. And it is my surmise that within a few years or perhaps a couple of decades, we shall see emerge new monetary systems more reliable than the big currencies that are used nowadays in the world. That is the dollar, the euro, the yen, the pound sterling, and soon the Chinese yuan. Let's go back to simple financial products, insurance policies, for instance. There's a client A and an insurance company B. A pays every year a premium to B, and in case a damage happens to A, B will pay to A a certain sum. This is a financial product, the contract linking A and B. Let's talk about futures. Suppose A and B sign today a contract stipulating two things: a price today, to exchange goods for money at a future date. This has been going on also since antiquity. And let's finish up this lesson with the description of a call option. Today, on February the 15th of 2011, one Google stock sells for $628. A call option is a contract between two agents, A and B, who agree that B will be willing to sell to A one Google stock for $600 in the future at the date June 11, 2011, but if A wants, and for this right that B grants to A pays B today $50.8 for this right that is called a call option. And on June 11th, 2011, of course, if Google stocks on the stock market are exchanged for less than $600, A will not exercise his right. Whereas, for instance, if Google stocks then are sold for $700, then it will be a great opportunity for A to acquire one Google stock at $100 less than the going price then. And A will have paid once again $50.8. That's the going price today for a call option. Exercise price $600, exercise date June 11th.